Good afternoon, everybody. I hope we're all okay and well and healthy. We were asked by Louise and Sarah to sort of come up with a little presentation, which is really an interactive discussion, I hope, on really the markets, what could be happening to the value of your investments. Obviously, the coronavirus has had huge implications for society, globally, regionally, economies, etc., etc., and that fallout is clearly still going on as we walk through a very, very fluid, changing environment. So what are we going to talk about today? Well, hopefully the idea is to have a quick look at how the virus has affected global markets, to consider the effect it might be having on your pensions and other investments. And the key point is, yes, we are interactive. Please ask questions using the chat function so that we can reply. We've already had a number of questions emailed in, so we will try and wade through the questions as we go, if that's okay with everybody. So, who are we? Martin-Redman Partners, independent financial advisors. We were set up in 2012. We give independent advice to clients in Cambridge, Suffolk, all the way up to Rutland. We advise on investments, pensions and retirement planning. Who am I? My name's Ben Sear. I'm the managing director of the business. And Sarah is with us, Sarah Austin, who is one of our independent financial advisors.
Hello all, hi, good to see you all.
So, how have markets reacted to past events? I think the idea of looking at this in context, because we are so early on into a slump, a recession, whatever we want to call it, is probably a good idea. So this graph really just looks at the FTSE 100 since it formed in '86, and we've highlighted numerous crashes that the FTSE has suffered since then. We have Black Monday, which, if memory serves, is crashing out of the RM. We've got a dot-com crash, early 2000s. We've got the global financial crisis, which we all remember. We've got the Brexit vote, which actually was quite nasty on the markets, but we kind of forgot about. And then we've got the latest drop with coronavirus. So these are market events. This is generally how stock markets move. And as we can see, if you'd stayed in the market from January '86 to now, you'd have seen a huge return, although over that time, your money will have gone up and down. And these peaks and troughs are what we call volatility. It's a measure of risk. It's how the markets move. It's a measure of investor confidence. And you can see how, if you look at sort of the dot-com crash, it took about 4 years to get back to where you were. If you look at the global financial crisis, which, if memory serves, when the papers were talking about it, was saying it's going to be the biggest recession since the Great Depression of the 1930s, actually, people were almost back to where they were within close to 2 to 3 years. So at the moment, we are just in such early days that we really don't know where we are. And I guess that leads into, what happened in 2019. To keep on with the context, 2019 was actually a volatile year, as this graph shows. So the green line is the Chinese, the Shanghai Stock Exchange. The red line is one of the US indices, the S&P 500. And the blue line is, excuse me, yet again, the FTSE 100. And what this shows, yet again, in bigger relief, is the sawtooth pattern of last year, the ups and downs the market had. This was when Trump was arguing over his trade war with China, for instance. This is when Boris was losing so many votes to do with Brexit. And it shows how actually the election came and the markets ticked up. So even in a volatile year, the FTSE actually did really well for an investor. And in fact, all of those major exchanges were up quite significantly. So we've come into this year, we've listened to what's going on, and we've heard people talking, and we certainly heard people who know far more than we do, talking about potential slowdowns in global economies, potential recessions. People were saying, is the market running out of steam? That was the environment that we were being told to prepare for as IFAs for this year. Our portfolios were positioned to be slightly more defensive. They were holding more traditional safe haven assets like gilts or bonds, because equities were expected to have a more volatile ride and not produce as much this year. Then in December, we start hearing about this newfound illness discovered in China called coronavirus. And the media picked up on it a bit. it was contagious, people were worried, but actually the markets didn't react too badly. So what happened in 2020? Well, we heard about the virus, but actually for a month or so, everything seemed okay. And then suddenly the virus kicks off badly in Wuhan and Hubei, and China implement lockdown. The Chinese market drops very significantly. UK and the US carry on going. We carry on going in normal. Italy's got problems, Europe's starting to get problems. We start to see the virus spreading. Then we have airlines starting to shut down, stop flights. We have repatriation issues. And suddenly the markets and investors start to worry that actually the global political responses haven't been strong enough. Governments haven't been strong enough. And before you know it, we had a situation where the markets just literally tumbled. So this is sort of the 18th of March down to the 23rd of March when Boris puts us all in lockdown. And you can see that the market, the UK market, was down by 25%. That's a huge tumble over that period of time. And understandably, we're all sitting there as investors, as advisors, going, wow, what's happened? What's happened and what can we do? And hopefully we can try and sort of answer some of those things for you as we go through today. What it does show, though, looking at this graph, if anything, is it's not all doom and gloom. When investors are worried, they are almost just reacting to daily news events, almost hourly news events. So as much as a market can tumble downward, in one day, the UK market after the lockdown, I don't know if it was just after lockdown or not, but it shot up by 9%. That's a huge return for one day for the FTSE 100. So it shows that investors don't really know where the new normal is. They don't know who to trust and they don't know what to do at the moment. So at the moment, I think volatility is very much a key word that I think whoever you listen to will be talking about. So let's have a look at some of the questions emailed in, and let's ponder those. And maybe Sarah wants to sort of jump in with some of these questions and ponder them as well. So, you know, the first one, great question. If you've got cash, should you be conserving it, or should you consider investing it? Considering that markets have fallen sharply and will inevitably rise again, I need to put my teeth in today, when the pandemic is over and markets recover. It's a great question, and advice is so personal to your situation that I'm not trying to avoid answering it, but I'm going to avoid answering it if that's okay. For people who are maybe going to lose jobs, for the self-employed, for those of us with high costs who might be taking a 20% or more pay cut, cash is king because cash lets you pay the bills, cash lets you put food on the table. So we'd be saying at the moment, if you can't afford to take that risk, then cash is king. However, if actually you've got cash in a financial product or cash ISAs and you're secure and you're confident that actually our family, my unit, has the ability to get through this, well, the markets are low. Will they go lower? Quite probably. Will they go higher? Quite probably. Volatility, it's going to be a sawtooth. Advisors talk about time, not timing. And for us as IFAs, we're all about how long is your investment horizon? If you've got a long-term investment horizon and you can come into a market when it looks low value, then hopefully you will see some reasonable returns, but it does come down to your situation and your views on risk. And please remember that throughout this presentation, we're answering questions generically. We're not giving you personal advice. We don't know your full situation. If you want to talk to advisors, I know there are a few of us actually in the room today, and certainly Sarah and I are more than happy to talk to you on a one-to-one basis if you'd like to at a later date. So what do you think, Sarah? Is that a reasonable?
No, I think I'd very much mirror what you've said. I mean, in terms of investing cash, if you've got that to one side at present, it's one really, what's your job security like? Are you going to need that cash in the next 5 years? In which case, it's probably not advisable to look at investing at this point. But if you're able to invest over a medium or longer term, so we're talking at least 5 years, between 5 and 10 years, it may be a good time. Because the market's already priced in a lot of concern over the coronavirus and how governments and economies are going to react. But again, mirroring what Ben has said, it's very much a personal very much linked. The advice we would give you would be down to your personal situation, and making sure that if you put money into the markets now, you've got a good solid buffer behind you in case you lose some of your income, or you've got costs that are coming up in the next 5 years that you might need access to that cash too. So yes, it could be, but like Ben said, we can't give an exact answer to that question without knowing a little bit more about the person's individual situation. So I hope that gives you some context to answer that question with. So should we move on to the next one we've had in?
Yeah, looking at the chat, I think there's a couple of nice questions that bring in there. So John D has mentioned pound cost averaging if affordable. I think that's a great point. So what, John, I would, without trying to paraphrase you or put words into your own mouth, John is suggesting is that if you start going to the market, if you can go in on a monthly basis, over time you're benefiting from what we talk about as pound cost averaging. You're going to buy at different values throughout the recovery or the crisis. So you're going to buy some shares at one price one month, they'll be at a different price the next month and a different over time. The benefit is that you are, yet again, going into the market and not trying to time when you buy. You're actually saying, I will just slowly get exposure over time, which means hopefully that you buy an average of the market, not a high or a low. So that is a really good point, and thanks for putting that up there. Angie Moyes has asked, if China is picking up, does that make you hopeful for global markets? To be honest, yes. I'm not an economist, though. I'm a financial advisor. My read is that if China is picking up, it does make you hopeful, but we all have to remember that China's such a different state to how most other states in the world are. They're authoritarian, and they had the ability to control the virus. They actually had the ability to lock it down very firmly. And now if you look at Chinese borders, they really have locked it down and said, it's not coming into our nation at all. They have that power, and that has helped them a lot. I'm not as confident about what Western economies and society and politics will allow us to do with that. But yes, certainly there is more positivity there, that China is already showing green shoots of recovery. So I think that is good. Michael, have we reached the bottom yet, or is there more pain to come? I wish I knew. I wish I knew. I don't. There could be more pain to come. I think if we all read the news, every day we hear good news and every day we hear bad news. I really I'm not sure. I think there is more pain to come.
Yeah, I would agree with Ben on that. Yeah, the news currently is still quite negative. We know that markets are quite emotional in the way they react. So I don't think anyone can tell you they can call the bottom of the market, because there's so many different moving parts. But there may be more falls as we go over the next month or two. But it's that lovely thing of having that crystal ball that none of us do have. But we can just look at different metrics that are coming in. But yes, there could be further to go to reach the bottom, but no one can really tell you with any certainty at all.
So I think that hopefully answers those few questions. Is there not an argument that the previous crises were largely to do with the correction of market overvaluations, whilst this one is actually a shutdown of the world economy? Mr. Knowles, thanks for the question. Yet again, it's one for an economist. Yeah, I think you're right. There is an argument to say that. But if memory serves, if we go back to 2008, I think we were probably saying that looked like a fair old shutdown of certainly the financial sectors, which people were milling up to be a far bigger event than it actually became. And I think the problem with every crisis is that we always look back in hindsight and say we should have. When we're in it, we just don't know. Not a great answer, Frank, but that's the best I can give you. And certainly if we need an economist to come and talk, it might be something for Louise and Sarah to look at, because that would be a really interesting conversation. So I kind of think, I hope we've answered most of your questions there. What proportion of a pension scheme do I think should be in cash at the moment? Ooh, lovely question, Jonathan. Difficult, really. To go to cash now, I'd be saying, hang on. If you go to cash now, you're accepting potentially a loss of 10 to 25% on your pension fund, depending on where it's been invested. Time not timing, what are your horizons? If you can stay in the market, and recover your position is probably a better idea than selling to cash, unless you think you can guess the market, find out when the low is and get in and make that return. But it comes down to, yet again, your situation, your views on risk, your strategy. As advisors, we really are about long-term planning, and then that's, deciding to jump in and out of markets probably isn't our marketplace at all. It's more for a stockbroker, I would believe. And it kind of comes to the question on the board in a way. Now that markets have fallen, is it too late to move pension funds designed for growth into options such as low-risk bonds and gold? Well, sadly, I think it is personally. If you sell now, you're going to sell out of assets that have fallen a long way, and you're potentially going to be buying into assets like bonds and gold that have actually risen in value. So you're actually compounding a loss in a worse position in a way. So I think if we are where we are, and I'm invested like most of you are in the markets, it's about, can I put my tin hat on and can I sit tight and can I wait for things to recover? It's not the nicest of answers, and it's a difficult one for us all to do. And it does come down to how we feel about money and how emotionally involved we are. But generally, there is a lovely graph done by an American financial advisor who talks about behavioural finance. His name, I believe, is Carl Richards, and we didn't put it in the presentation, but it's a sine wave. It's a lovely graph of a sine wave, which is behavioural finance, and it shows that the majority of us always sell on the way down and buy on the way up. And we did a piece looking at an article by Fidelity probably about 3 or 4 weeks ago, when we realized the crisis was happening. And it explains that, unfortunately, if you try and time the market, actually, if you lose, I think it's something like the 30 best days of a recovery, you can lose about 10% growth. Now, don't quote me on those numbers. If you look on the website, our website, MartinRedmanPartners.co.uk, thank you for the shameless plug, you will find that article under the Knowledge Centre. So we have got that kind of information there for you all to read. And we can see where that is going. So hopefully that's answered more of your questions. Is that, what do you think, Sarah? Is that okay?
No, I think that's good. I was just about to post the link actually to that article you mentioned onto the chat box now, just in case people want to have a look at that after the session. Okay,
yeah. Certainly, Frank has asked a really interesting question, which is good for all of us. As business failures will inevitably pick up, banks will take losses. Are we advising clients to stick below the government guaranteed cash holdings per bank? We always have been since the last recession, Frank, is the honest answer. There are significant risks with holding too much in terms of cash in any bank. It's pretty hard to do when your pension funds might be pretty highly focused in one or two funds, and that's something that is worth bearing in mind. But certainly, you are right, Frank. I think there could be some big casualties out of this, and if you can minimise all of your risks by looking at things like the Financial Services Compensation Scheme, it's worth doing. For those of you holding big sums of cash, it's tricky to do. There are companies out there. There's a Cambridge company, I think they're part of the Cambridge network, called Insignis, for instance, who deal in cash management. And it might be worth actually Louise chatting to Giles and seeing if Giles wants to come on and talk about what they do in this marketplace, because what they do is pretty phenomenal. So there are solutions out there. But yes, Frank, thanks for making people aware. I think that is a really good point. Very well made. So if we move on then from these, how do we think this relates to your pensions and investments? Well, brutally, the honest news is that the value of them will almost certainly have fallen in the past 3 months. Unless you really did have a brilliant crystal ball and you saw what was coming, or you've been spooked by the rise in volatility and gone to cash, practically every asset class has fallen in value over the last 3 months. However, not many of your pensions and investments will be in 100% invested in equities, certainly not if you've been working with financial advisors. Most financial advisors will talk about having a diversified or balanced portfolio, which means that we talk about holding some equities, which could be the UK, the US, Europe, Japan, some fixed interest shares like corporate bonds and government gilts, property holdings and cash. And the idea of having all of those different types of asset classes, that basket, is that actually, as one goes down, hopefully others won't go down as much, or some might actually rise in value. So what we did for this graph is we looked at, yet again, that 3-month window from the 1st of January. What's the FTSE 100 done? And then if we look at the Investment Association, which is an association that looks at baskets and baskets of funds and how they've performed. Well, we looked at what 2 of their sectors had done: a mixed investment sector holding between 0 to 35% of shares, and a mixed investment sector holding between 40 to 85% of shares. How have they done compared to the FTSE 100? It's just to give you an idea of the benefit of diversity, and hopefully this is where your pensions will be. So as much as the FTSE has gone down by 25% up to when we did this graph on the 30th, actually the IA sectors, the lower risk sector, 0 to 35% of shares, has only gone down 8.1. The mixed investment sector has only gone down I know it's only 16%, but they haven't gone down as badly as the FTSE 100. That's the message. There is a benefit in being diverse, and hopefully most of your investments and pensions are diverse. So what we did there was we said, okay, well, we know that. Now, we also know that the government introduced everyone to have auto-enrolment type pension schemes, workplace pensions, a number of years ago. So we thought to ourselves, well, we're telling people that actually we hope you haven't suffered as much, and that's the truth. We do hope you haven't suffered as much. So let's just take a stab at who we think some of the main auto-enrolment providers are. Let's get a rough grab on where your pension may be and how have they done. So literally this is just guesswork. There is no science in it. You could almost argue there's no logic in it. But we said yet again, what's the FTSE 100 done? What has the Royal London Governed Portfolio 4 done, which is generally a pension that a balanced investor would be in if they were between the ages of, I'm going to take a stab at 35 to 50 as a rough guess. And the same thing for the MyFolio Managed 3 fund. It's a fund offered by Standard Life that generally we think is a default strategy for a lot of auto-enrolment pensions, or certainly that's what we see from our side of the fence. We're not saying you're in it, but it just gives you an idea that, yet again, if you are that worried and if you haven't opened up the can of worms as such to look at where your values are and what has happened, the market, this graph actually was done up to the 31st of March. The market was down 23.84, but both of these funds, one was down by 14%, one was down by nearly 17%. They hadn't gone down as badly as the market has. So yes, I understand it's still doom and gloom, but if you have been put even into a default strategy, hopefully that diversity shows that there is a benefit for being diverse with your investments. So that is interesting. So what can you do? You know, and this is, I guess, why we're all here. What can we do? What can you do? What can we do? Well, think about your views on risk. The amount of exposure you have to risk assets, equity exposure, should reflect your view on risk and how long you plan to invest for. So if you don't have a long time till you need to take your benefits, and one of the questions was from someone saying, hey, actually I needed my money in 4 years, what should I do? That's a brilliant question that I'd love to ponder really on a one-to-one. I've got some graphs that I'll bring up later and we'll come to that. If you need your money in the short term, yes, you're in a pickle because the market has gone down so far. How quickly will it recover? We don't know. The global recession, the global financial crisis took about 2 years, I think. The dot-com bubble took about 4 years. We just don't know how quickly the market will recover, but markets generally do recover. Make sure your investments are diversified. It's a key thing, it's a key lesson that we should all learn. How do we keep our investments diversified? Diversification is different asset types, different sectors, different geographies. That helps spread risk. You're not just relying on the performance of the FTSE 100, for instance. And as mentioned, take that objective long-term view. Markets will go up and down. It's the natural cycle. And the longer-term view shows that actually from here to here is generally an upward trend. The bumps in the road are hopefully just that, bumps in the road. And history has shown so far, touch wood it will continue to, that markets do recover. Anything to add on that, Sarah?
No, I think that's really concisely said, actually. No, it's just very much about making sure that you've looked at how long you can invest for. And really important is really to look at your views on risk. So making sure you're not invested too cautiously or either too adventurously, so you're not losing more money than you feel comfortable with. You basically, when we advise clients, we want them to be able to sleep at night, so we do a lot of work on risk and how they feel about risk and how they'd feel if their investments fell a certain level, to make sure that they're really invested according to how their views on risk are. So they're not basically in markets where we've seen a crisis like this, they haven't lost more money than they were expecting to lose. And we're quite fortunate that all of our clients are in that position within our firm. But no, that really, to summarise those 3 points, I think you got them quite clearly.
Thank you. And then so the other questions that we did receive were, is it worth drip feeding in investments over the next few weeks and months? And I think that's where John D came on and said actually pound cost averaging is a good idea if affordable. And yes, I do believe that completely. I think the market is, we can see it's down, we can see it's lost value, even if it has further to go. Putting a lump sum now would be a significant risk. Dripping it in over time would make more sense, in my opinion. I would normally use my ISA allowance in a tracker fund in April. What is the best option for a modest chance of beating inflation over the next 10 years? Index funds are good and index funds are bad, aren't they? An index fund is a tracker fund, and what it's doing is it's just going to follow that index. So if that index goes up, your fund has to go up. If that index goes down, your fund has to go down. It is a computer program. That's, to me, still, if it suits your views on risk, it's still a good solution. The markets are low. I think it's probably an opportunity now to look at. But what is the best option for a modest chance of beating inflation over the next 10 years? Depending on your views on risk, yet again, I'd say a diversified portfolio. That's what we talk about. I sound like a stuck record. Tracker funds are good. If you've got a view on risk, I think looking at a tracker is worth considering. But if you want to be more moderate, be more cautious, a nice balanced portfolio using some classes in developed markets and maybe paying for active managers in less developed, more risky markets where you want someone to make the right calls for you. I think that'll give you a good chance of trying to beat inflation over the next 10 years. So I think we've answered everybody's questions apart from one, which is really, ethical funds have done very well over the past year. Will they do as well coming out of the crisis? Michael, I'm sorry, I'm the wrong person to ask on that one. Ethical funds are a marketplace that I've never really got involved in, never really researched. I'm not saying I'm unethical, but as an investor, it's not a marketplace I've played with. So on that one, I'm stuck. It's really interesting how they have done so well. We do often look at a responsible portfolio, and you're right, they haven't fallen by as hard, but I haven't investigated why we have very few investors in our company who are investing in ethical funds at the moment. So it's not my area of expertise, and I wouldn't want to make a stab at that and get it horribly wrong in public.
Has anyone else got any other questions?
Thank you, Frank, for telling me I'm behind the curve on that one. I will take the opportunity to do the work when I have the time, if that's okay with you, sir. So if there are any more questions or not, let's, thank you very much, and over to Sarah and Louise.
You're welcome. Thank you very much indeed for doing that and keeping an eye on the chat as well. That's very impressive.
Thank you.
Yeah, I was just going to give a couple more minutes there in case there's any more questions, but doesn't seem anyone's got anything at the moment. As Ben mentioned, you're welcome to follow up. If you think of anything after the session, then you can get in touch with Louisa or myself, or there's Ben and Sarah's contact details, so feel free to drop them a line as well if you've got any more questions.
Yeah. If you'd rather ask a question not on a public forum, feel very free just to reach out to Ben or I. We'll be very happy to answer any questions you have.
Lovely. And just one more note, if you missed it at the beginning, we will be sending round a recording of this session. So if you do want to catch up on any of the points made, we'll be able to send the video round to you. Oh, there's just one more question come in, if you want to check that out.
That's a really interesting question, Mike. I haven't got a clue, is the honest answer. Cambridge is an amazing sort of microeconomy in a way for venture capitalists. I know there are lots of people working in incubators, helping develop new technologies, new sciences, new medicines, etc., etc. I would presume that people will still be looking to invest. People will still have new ideas, and new companies will still be supported in the future. Will it slow down that market? Certainly. I think investment will dry up fairly quickly in that market space at the moment because people are scared. But I still think people with the right ideas, people with the right products, people with the right intelligence, there are people in Cambridge who are happy to help and who would help people move forward on that. So great question. To a certain extent, we're just going to have to sit tight and wait and watch. And see what happens there, but it's a rocky road for all of us, I feel, at the moment.
Great, lovely. Thank you very much. That was a really interesting overview and some great answers to your questions. So if that's it, then I'm going to end there and end the meeting. But thank you all for coming along, and hopefully we'll see you at another session again soon. Thank you.
Thank you, Ben. Thank you, Sarah.
Bye-bye.
Sarah.